Okay, guys, today we're talking about a topic called return on investment, or ROI. Okay, this is going to be slightly different than what we're going to learn later, which is return on equity. This is just basically what we put in versus what we made. Okay, so in our first example, we're just going to take a look at a straight capital gain or capital appreciation in an investment. So we start off, we're buying 100 shares of stock, and we bought it at a price of $20 per share. Okay, since we're paying $20 per share, you multiply 20 times 100, and that comes to $2,000. That's our initial investment. So that's what we're going to measure our return against. I put in $2,000. How much do we make off of that investment? All right, so now a year goes by, and we sell those shares for $24 per share. Okay, so at $24 per share times 100, that's $2,400. So if we take the difference between our proceeds, what we sold it for, $2,400, minus our initial investment, $2,000, we made a total dollar gain of $400. $400 is pretty nice, but now let's measure that against what our investment was. So to get ROI, it's always your return divided by your initial investment as a percent. So our return was $400. Our initial investment was $2,000. 400 divided by 2,000 is 0.2, or a 20% return on investment. Okay, so that was pretty nice. And that was just capital appreciation. So now let's take a look at, by itself, a dividend, what a dividend can do to your portfolio. Now, our dividend gain is we buy 30 shares of stock at $20 per share. So 30 times 20 is going to be an initial investment of $600. That's what we're putting in. Now, the company pays dividends of $1 per share. So if we had 30 shares, we get $1 per share over the course of the year. We get a total return of $30 in dividend income. So once again, our ROI, our return on our investment, is the money that we got, our return, $30, divided by our initial investment, $600. 30 divided by 600 is 0.05, or a 5% return on investment. Okay, so we've got capital gains and we've got dividends. We looked at them separately in example 1 and 2. Now let's take a look at their combined impact. So if we go down to our third example, we're going to look for a total return, a gain in principal plus dividends. Okay, so here we're buying 100 shares of stock at $30 per share. So $30 per share times 100 shares, that means our initial investment was $3,000. A year later, the share price rose to $33 per share. $33 times the 100 shares that we have, that means our investment is now worth $3,300. So the capital appreciation, or the gain in principal, what we can sell it for now, $3,300, minus what we paid for it, $3,000. That means we had a $300 gain. Now the company paid dividends of 90 cents per share total last year. So normally dividends are paid out 4 times per year. We're saying in total we got a lump, or we got 90 cents per share total. So 100 shares times 90 cents per share means we were paid $90 in dividend income. Okay, now the total return is going to be our gain, our capital appreciation, plus our dividends. Well, our capital appreciation was $300. The dividends that we took in were $90. So that's a total return for the year of $390. If we compare $390 to our initial investment, 390 divided by 3,000 is 0.13. That's a 13% return on investment. Now, if we took a look at these separately, 300 divided by 3,000 would have been a 0.1, or a 10% return on investment. 90 divided by 3,000 is a 0.03, or 3% return on investment. So the added return, dividends plus capital appreciation, is going to give us a total return, or ROI, of 13%. So these are the types of examples we're going to take a look at today. There's going to be a Google form that's going to go with these three types of examples. In every case, every example, we made money. So that's all we're looking at today, is making money off of capital appreciation, making money off of dividends, or making money off of both. As we come back from break, we're going to take more looks at examples where return on investment from an option purchase, okay, a negative return on investment, with dividends easing some of that loss. So that's what we're going to be taking a look at today. There's a Google form that's going to relate to that. Plus, we're going to be learning a little bit more about options today. What's the difference between a call and the put, and terms like in the money, out of the money, or at the money.